This is video 2 for Wednesday, November 17th, 2010. Didn't notice that we were running out of time on the previous video. We were talking about the divergence strategy here, firing off some long trades. There's about a 6-tick downside to this low here. And we had retracements above the market, high probability retracements. And what I was discussing here was the way in which you handle stops. Now, when we get our warning signals on a trade that's already gone negative, my position has been it's probably best to dump the trade. I'm not going to tell you to dump it immediately, but to dump it at the earliest logical possibility. What does that mean? I guess that's up to you. But the other side of the coin, to balance out the issue of dumping a losing trade, is the fact that you already know you've got nearly a 90% probability that this market will go back up. Now, how do you joggle a losing trade against a high probability that it will come back on you? I don't know. I really don't know the answer to that question. The safe thing to do is to dump the trade and look for another entry. But as you can see, we didn't get another entry, at least not on this strategy. And by the way, I'm going to tell you why. Why didn't we get another divergence here or here? Now here's the reason. When the SPOOs dropped lower into this low right in here, and then again in here, look at where the premium was. Right there in this low, the linear regression is moving up towards fair value, and we believe that it is taking on a higher risk to execute a trade where the linear regression has already exceeded fair value, executing a long trade. So that's why we didn't get a signal here. It didn't meet our rules. When it came and hit this low, the linear regression was fine, but the low of the premium exceeded our lower threshold with our margin of error. So neither did this meet our criteria. Now, had I been manually trading, yeah, I probably would have taken that trade. I probably would have taken this trade. But we have to have rules and we have to follow them in the strategy. The strategy has no choice. But this is why it's critical to learn how to read the premium. Because if you don't know how to read it, then when opportunities exist that have not been factored into by way of the strategies, you may not be able to know what to do. But if you read the premium, if you know how to read it, then you can say, you know, there's an exception here. I can see that there's a good reason for me to take a trade even though I don't have a signal, given that we're just off of our criteria by a little bit. So that's your answer. All right, strategy performance report on the divergence. Now let's talk about the trend. In our workspaces, when we're talking about the trend, the trend's either up or it's down. So we've isolated charts to trade in only one direction on the trend. So this chart that we're about to show you now is based upon a short trend. And we have no signals until here. Okay? and then here. We have a variety of different strategies, slightly different settings, and we can kind of see from this that there are specific settings that definitely work better. Suffice to say that the strategies that have the large, round, pinkish signal here, or the large arrow here, have better entries than the smaller round signals and the weird looking arrow here. Better entries. If the signals are yellow, they're also slightly better settings. You can see they're all hitting their profit target. And then in here, again, we have that large, we have actually every strategy nailing this particular position. Also, see, we've got 1, 2, 3, 4, 5, 6, 7, 8. We got 8 different strategies on this with just slightly different settings, but they're all firing off at the same time. And we've got this target down here. It would be reasonable to expect that that trade will eventually hit the target. But the point of the matter is we've refined our trend settings. I think we're very, very close to using very specific settings for the trend. We've been working on this for a while, and I've been a little bit disappointed. But here's what we came up with that seems to work very well. We use an OBOS on a fast 3-tick SPC with the stochastic set to a much larger interval on the large contract, refined by an ES50. That looks good. It really seems to be working well. So we're going to leave these settings go for a few days. I think we finally nailed it. I've been frustrated, I must admit. On our previous trend settings have been firing off a little prematurely and not really taking the short-term trend into consideration. The big trend is not so bad, but I don't like to enter the trades too soon. Okay? Performance report. All right, let's look at the long trades. Now, to show you a contrast here, and this is a really interesting contrast. The long trades, we set up the strategy workspace so that some of the strategies used a simple stochastic. Let me get that back. Just a simple stochastic with the trend setting, which of course reads the premium, versus a stochastic that utilizes an OBOS approach along with the general trend. Okay, so this is using OBOS, and so is this. Here's the major trend plus the OBOS. Overbought, oversold. Okay. The round circled trades use the OBOS. All of the other trades do not. Very good entry here. Not so good entry here. Very good entry here. So when I say I think we've got it, that does appear to be one of the significant things about the trend setting that should be incorporated. Use the OBOS approach. Overbought, oversold, along with the trend. And then, of course, our proprietary premium reader. Can't forget that. All right. I just show you this just to be letting you know, this is where it turned out. Okay. Let's see. All right, I really don't think there's anything else for us to be commenting on, so we'll just wrap it up with this. The divergence setting did work very well today. So did the trend. I didn't comment about the pivot strategy because we've been talking about that too much. This pivot strategy did fine too. But this was a blue day, interestingly enough. And last thing I want to do, let's call the trade for tomorrow. Let's see if we've got fair value. Okay, we don't have fair value yet, but we have run our proprietary calculations. In all probability, fair value is going to move up. And given that it will move up, that will call for tomorrow's trades in the morning to be short. We called today was destined to be long in the morning. It was. We've been accurate every day on our calls this week. Before the open, what we expected to happen in the morning has been 100% accurate. So tomorrow morning, we're looking for a short. And let's see, what else can we say? All right, just a simple recap. You have retracement lines based upon the premium or even the VIX, 90% accurate or better. The worst day we've ever had has only been 85. High probability entries, very accurate, based upon reading the premium. A bias that helps you to know overall what direction is most probable to trade in. Warning signals to let you know the market's moving against you. Further schooling about the pattern of the day, knowing when in the afternoon particularly, when your best exits are likely going to be and in what direction they will be. You put that information together in a strategy and you have got yourself a real winner. Our motto is never have a losing day. One of our mentors years ago said, if you can learn how to trade the S&P 500 and do it right, it may not make you rich, but quite likely it could make you a fortune. Now, I don't propound to be rich, and I don't suggest that you should try. Life is far more valuable than making money, and money never made the man. But I can say this. I can't think of a better business to be in but learning how to trade the E-mini S&P 500. So come to our website and ask for a demo. This is Rod Kusin and Spooman for Risk.